what do you think most financial companies will show you? They'll show you the average, not the actual, because it looks sexier, right? It's not lying, but
So they're
it's not
cutting out the
fully true.
losses, right?
Just so you know, your 401k does have fees. It's usually anywhere from about 0.7, 0.65, all the way up to maybe 2% plus. I actually saw a 401k plan that was charging over 2% a year in Washington state. So there's some out there just ridiculous.
On today's podcast, I'm bringing back an old friend, Chris Miles, but I think a lot of people who come to the retreats or have been part of our group start to realize it's essentially the same cast of characters over and over again. And even with our, general partnership partners on the operation side, on the business, I think you hear this with real estate is a relationship game. And even in financial services, it's a small world. I think Chris and I met back in 2016.
Yeah.
I don't think at that time we were having these initial conversations of infinite banking. Chris does that today. These are the people you climb the ladder with and bounce ideas off of. We're going to dig into Chris's story today. It's great to meet other people on podcasts or YouTube videos who've already made it. So you have that blueprint. Meeting folks like Chris and having that current camaraderie growing up has actually helped me a lot more as I reflect in the last decade. Certainly, it's made it a lot more fun. Chris, welcome to the show once again. A lot of new people who take interest in the FIRE movement or financial independence, alternative investing space. Take us back to your awakening moment, right? Because you were doing it the traditional way for quite some time.
Yeah, I actually started out, I've been financially independent on and off. First time I was financially independent was back almost 20 years ago to this date, but it wasn't that way in the beginning because I went to college. I realized pretty quickly going to college, you're not really going to get financially free per se, right? I saw I was going to be on this path of being an employee. I figured I want to be an employer. Like I want to be the one that, even if I was like a consultant or something like that, where I could control my hours, control my time, control my destiny. I went down that path because of my dad. My dad was the penny pinching saver. He was the guy that Dave Ramsey would have been so proud of, even though my dad's older than Dave Ramsey by about 15 years. My dad was like the penny pinching saver. He was telling me just to stuff all your money away. And when I was looking for that career or something to get into, the thing that came up was being a financial advisor. I thought, well, that could be cool because if I can learn about money and investing, maybe I can create some freedom for myself, but maybe I can even give freedom to my dad because he was the guy who always said, hey, we can't afford this. We think I am made of money. Money doesn't grow on trees. But the worst one he always shared was that he figured his job would literally kill him from the stress. Because by his 40s, he'd already had strokes. He had a heart attacks in his 50s. I was actually there when he was getting hauled off to the ambulance when I was in college. He said, hey, here's my stash of money in a can above my dresser if you need to get to it. That kind of stuff he was telling me. When I became that financial advisor, I was hoping I would give him some of his life back. I did that for 4 years. I was the traditional salesman in a suit, selling you mutual funds and all that kind of stuff you've been taught. Just put your money away forever, pay off all your debt, set and forget it. And then hopefully with a miracle of compounding interest and the rule of 72, someday when you're old and gray, you'll be able to enjoy that lifestyle too of living a lower class to middle class lifestyle. And that's really what I was selling people. About 4 years in, at the end of 2005, my dad said, Chris, when are you going to advise me? So I went to his house. I grew up in Oregon. I went to his house, sat at the same kitchen table where he told me be a penny pinching saver, right? And as I'm sitting there at his table, I'm looking at all of his numbers for the first time in my entire life because he never wanted to share his money stuff. Well, I'm seeing all of his numbers. He paid off his debt, including his house, in 18 years. So he's 100% debt free and proud of it. Stuffing money in his company 401k, getting the match like every good boy and little girl should. At the end of this, I had to say, Dad, here's the deal. You're 61 years old. And if you want to retire today, you better hope you die in about 5 years because that's when you're going to run out of money. That's not what I want to hear, Chris. What do I do? I don't know. You did everything right. You did everything that I've been teaching as a financial advisor. I don't know. And Lane, I'll tell you, that bugged me to death. I was supposed to have all the answers, right? I've been teaching people selling on hopium, that hopefully someday people are going to be able to retire when they put money away for 30 or 40 years. Yet my dad did it and he did it the right way, in a way that Dave Ramsey would have said, he's my man. And yet it wasn't enough. And of course, when the students ready to teach your peers, I had a friend who I hired to be a financial advisor. He quit to go do real estate investing. So I called him up. This is like the end of 2005, right after Christmas, going into New Year's. I was just like, hey, Merry Christmas, man. Happy New Year's. How you doing? What I was hoping to hear him say is, yeah, Chris, this real estate thing isn't working out for me. I'm broke. Can I come back and work for you? That's what I was hoping I would hear from his mouth. I got the exact opposite. He said, Chris, life is awesome right now. In fact, my dad and I have partnered on some real estate deals, and we've now doubled his income as a professor at the local university. I said, wait a minute, you've only been doing this for 4 or 5 months. That's too good to be true. There's no way that's possible. He said, all right, you can argue with me all you want, but it's happening. Finally, after we argued back and forth about stocks or real estate, what's better, right? Obviously, I was a stocks guy. And he says, Chris, how many of your clients are truly financially free where they don't worry about money? I said, they all worry about money. Even the retired ones still worry about running out of money too soon. How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these investments? I was sitting there thinking about it. There's guys been working here since the 1970s, since like I was born, and they can't retire either. And he says, there's your problem. And he says, go read the book, Who Took My Money by Robert Kiyosaki. There's this AM talk radio show. This is pre-podcast, right? These two real estate investors chat about founding fathers and principles and stuff. And so I did. I started like consuming all their content, read that Rich Dad Poor Dad book of Who Took My Money, which by the way, just tells you mutual funds suck. I just saved you 3 hours of audiobook right there. Long story short, either I keep on this financial advisor path, even though I know that it doesn't work, and I know there's a better path focusing on passive income versus accumulation theory that all financial advisors give you. Even though I know there's a better path, either I put blinders on, I just keep being a financial advisor, or I quit and keep my integrity intact. I did the latter. I said, I'm out of here, never teaching about money again. I'll just be a mortgage broker and I'll teach stock trading on the side. And so I actually did that. I wanted to know what these guys are doing with real estate. So I started to study that. Later that next year, I had a very small family. It wasn't hard to hit my fire number, so to speak, but I was able to hit it later that next year, where I had about $4,000 or $5,000 a month coming in, and I was financially independent when I was 28, almost 29 years old. In 2006, I'm bored, wondering what to do with my life. And 2007 came out of retirement to teach people how to do what I did, which is become financially free using things like alternative investments, the very things you talk about on this show.
So let's break down a couple of things you mentioned. The accumulation theory is what the financial planners, traditional investment world teaches, where you basically save your money and then you wait till the end, you have a big pile, and then use the 4% rule. Although some would argue, you would be able to safely withdrawals at less than that because you can't really count on the returns that baby boomers had during their ages. But you keep your money with the certified financial planner or stock market as they make their passive cash flow off the AUM fees. Normally, they'll take 1%, 2% off asset under management. So if you got $5 million with them, they're making 50 G's on you every single year for almost doing nothing. You mentioned, I never read the book, Who Took My Money, but what's the gist of that book, right? Who Took My Money? How do you break that down?
It really talks about the fallacies of mutual funds, right? Because that's the thing we were always taught, just like I was taught as a financial advisor, but really everybody's taught. We're all taught that the only way to invest is in the stock market. Now, you always hear about real estate investing. This is what I was as a financial advisor. You hear about real estate investing, but investing equates to stocks. And so Kiyosaki brings up that kind of stuff, right? He talks about the fees, like you just mentioned. There are fees that come out of your mutual funds that you don't get the full return. Not to mention, the number's different now. You hear most people say out there 90%, but even last year, only about 85%, the mutual funds don't even earn the same return as the S&P 500. And then you get all these other little myths out there, like average returns versus actual. Like we're always taught that the market's average like 10 or 12% a year. That's what I taught. I was actually a financial advisor and I was learning about this. There was already holes being poked in my armor, so to speak, as a financial advisor. I was stock trading, and stock traders think financial advisors are idiots because they're like, yeah, like that's dumb. Mutual funds don't really work. They're high risk, mediocre returns. They're just like watered down crap. So they're not a fan of it either. But I'll give you an example with the average returns. If you have $100,000 and then that next year you lose 50%, you're down to $50,000. I remember I was in a training one day, and one of these guys, they call them product trainers, right? Because that's what you do as a financial advisor. You sell products. He was selling a new concept because most of us had gotten beat up during Y2K, right? The 2000 through 2002 till March of 2003, the market was getting hammered. He was introducing this concept about average returns. He said, you have $100,000, you lose 50%. What do you have? And us being math geniuses said $50,000 because we can cut things in half. And then he says, Chris, how about this? And not just me, but everybody, right? Everybody in the room. There's about 100 of us in this room at this time. He said, now, what return do you need to get back to breaking even? All of us being those math geniuses said 50%. But Lane, so you 50,000, it makes 25,000. You're now only up to $75,000. You're not even back to where you started, $100,000. He says, no, that's not true. You need 100% rate of return to make up for a 50% loss.
Or realistically, you're going to grind it at 5 years at 20%.
Yeah. Or what? Yeah, exactly. Like depending on how the
Well,
numbers work out. But that's what
I'm
he said.
sure
He's like, but look at
our
the
smarties
average.
out there are like, no, it's 17% if you compound it, whatever, guys. But you
Yeah.
get the point.
But yeah, that's the truth. So think about it. If you lost 50%, but then next year you did make it back up and you made 100%, the average over those 2 years, you take 100 minus 50 is 50 divided by two, you get a 25% average rate of return, even though your actual return is 0%. So this guy who works for these financial institutions just said, hey, look at this. That means 25% return, but really it's zero. If you take out fees, you'd probably have to make more than 25%, even to break even. But he wasn't factoring fees at all. He's just saying the actual return was zero. And so his case he's trying to make is do these indexed annuities and things like that, right? So you don't get any stock market losses. And so there's a floor and a ceiling. And we're like, oh my gosh, this is crazy. And it's interesting because we did the math. We said from 1995 to 2005, we had our money invested. Even though the roaring 90s, there's huge, massive returns in the market, we would have had more money by 2005 had we not lost money because of that negative return. Once you have a negative number, the average and actual are no longer the same. What do you think most financial companies will show you? They'll show you the average, not the actual, because it looks sexier, right? It's not lying, but
So they're
it's not
cutting out the
fully accurate.
losses, right?
Yeah, exactly. And so I remember I cornered the guy out in the parking lot. I said, hey, so why don't all of us, and I was, about 28 years old at the time. I said, why don't all of us just put our money in these guaranteed type of funds? I can tell you're a young kid. You've got time. You can take the risk. You'll probably make more just gambling in the stock market anyways. I'm just offering another solution for you so that you can sell to other people that are scared of the stock market right now. That's pretty much when I woke up and realized I'm like, I am a salesman in a suit. Like literally, all the financial education that we all get come from people just like him who work for these financial institutions that pass on down to the financial advisors, and the financial advisors pass it on to you. So all the stuff in the media, even the Susie Ormans, who also worked as a broker until she had her licenses pulled, all these people have been taught and trained by these financial institutions to basically set and forget it, put it away forever. My goal was I wanted 60,000 a year. This was back in the early 2000s. I said, if I was just cheap enough, I'd turn off the heat in the wintertime, turn off the AC in the summertime. I just take all my nickels and gather it all together and save enough my mutual funds. Hopefully by the time I was in my 40s, I was hoping to have $2 million saved up. So then I can live on 3% a year, which is 60,000 a year, right? You mentioned the 4% rule that FIRE movement talks about. Even 20 years ago as financial advisors, we were questioning it even back then. And just so you know, they update that number every year, and that number is right around 3% to your full retirement age. That's not even talking about retiring early, which is more like 2%. So that's why I was saying 3%. If I could just be cheap enough, save up enough of those mutual funds, as long as the market doesn't tank on me in the meantime, which it did, by the way, even though I was out of the market by this point when 2008 crash happened. But still, it's like if I just save up, I'll have $2 million, 5,000 a month, with which from the early to mid 2000s was like having 10 or 12,000 a month today after inflation. 5,000 a month seemed amazing back then, but now 5,000 a month for most people is barely living unless you're single or just you and a spouse and you're living really cheap. It's really hard to live on 5,000 a month in today's day, depending on the state you live in. So I guess my main thing is there's all these things that came up, just like in Who Took My Money, all these little things, and even just compounding interest, the eighth wonder of the world, or even just the whole stupid dollar cost averaging. It's so brilliant. When you think about it, dollar cost averaging is the perfect marketing tool to get people to keep putting money in, even when the markets are going down.
It's like the whole just keep betting on the Dallas Cowboys idea. Just keep cheering for them, guys.
Yeah, and this
Yeah.
is not the time to do it. I'm just telling you, it's true. You don't know when it's going to be. What they taught me as a financial advisor is the three T's. You lack the time, the training, and the temperament to be able to trade on your own and to do your own investing. Therefore, you should just trust me with your money. By the way, like you said earlier, we do nothing. Most of the time, especially when I started, they used to have us pick funds, which means you're just guessing, like Blinken from Robin Hood Men in Tights, the blind guy up on the watchtower saying, I'm guessing no one's coming. It's like that when you're a financial advisor, you just guess and hope that it works. About the time I left, the thing that was starting to become more popular was doing these risk questionnaires to figure out what kind of investor you are. And then you just go in this moderate aggressive portfolio or moderate or conservative or aggressive portfolios based on your risk tolerance. You just say, here's where you go in that fund and just hope for the best.
Even though the client doesn't really.
No, you don't know. Everybody's just guessing. Like a financial advisor, they're not financially free. They don't know how to get there. They're teaching you like they know, but it's all based on calculators that they're giving bad assumptions, which by the way, the real rate of return, going back to that real actual rate of return versus average, the real rate of return of the S&P is about 8.5% for the last 30 years, which includes From 2009 till now, we've had over 15 years, only one down year in these last 15 years. You go back in history, pretty much unheard of.
It's like a 6 to 9 year market cycle.
It's almost like we skipped a whole market cycle of down years. In fact, by the time you and I met, I was actually writing blog posts called Y2K15, predicting that the market was going to crash in 2015. Then 2016 went flat until all of a sudden Trump became president, and then it shot up with the Trump effect, right? Like we saw happen just a few months ago. Same freaking thing. Nothing to support it at all, but it just starts skyrocketing. And so even think about it. The last 15, 16 years have been way higher than average, yet we've only averaged 8.5% real return on the S&P. That's it. That should scare you, because when you start to put in your numbers in a calculator, and then if they tell you inflation is only 2 or 3%, which by the way, as a financial advisor, I would put in 2%, because if I put in 3 or 4% inflation, it would depress you. So I put in 2%, so the numbers look better when you're in your 60s, right? But when you put in all those numbers, you start to realize I've got to save a lot more money than even they're recommending, in hopes I can live maybe a middle-class lifestyle.
And maybe break down to, you have your stock and mutual fund or even ETF holdings, they go up and down, but you get the statement. It's really hard to tease out the additional fees out of it. And then maybe talk little bit about, people think they're smart and they go to these low fee ETFs too.
Low fee ETFs, the trend going in that direction is better. It's definitely better than what most people are doing with financial advisors right now. They do have low fees, and they tend to outperform whatever you're going to get with some financial advisor or other mutual funds. That's been proven to be true almost all the time, but it's just not enough. Like I said, if the S&P is only paying you 8.5%, now someone's going to argue, they're going to say, Chris, the reinvested dividends, yada, yada, yada. Okay, cool. You might walk away with maybe 9.5 to 10%. Just so you know, 8.5%, I've been tracking the S&P for 2 decades, and I've been tracking the long-term average. This is one of the highest I've ever seen. Usually it's between 7 and 8%. That means you're lucky to get 8 or 9%. Now, someone might argue, they'll say, but yeah, Chris, but I got this 401k. I get the match. That's free money. I did some research on that too. I went to Fidelity, who was one of the top 401k providers out there. Fidelity has 45 million Americans as clients. Of that 45 million, only 810,000 have at least $1 million saved up in these funds. That means only about 1.8% of people are even quote unquote successful to get to $1 million. Transamerica did a separate independent study of those people that have over $1 million in those accounts. There's already 35% that say, oh, quote, take a miracle for me to be able to retire. A miracle. Like they don't even believe it will happen, because they take that 3% rule. $1 million, 3% is only 30,000 a year. Anyways, going back to Fidelity and their 401k funds, when I was looking at the last 10-year performance, it actually underperformed the S&P by over 2% a year. When you really factor in the real compounded rate of return of the match, even if you get a 100% match, it's not 100% a year. The way you can prove that is go to your financial calculator, your retirement calculator online or whatever you might do, and start putting in, say, a percent return on 20,000 a year that you're putting into a 401k. After 20 years, you'll be richer than Bezos at 108% return, because you don't earn 100% return. Yes, you get 100% match on the money, but it's not 100% return on all your money. So the best time to have a 401k to get the match is when you first set it up. The worst time to have it is as long as it takes every month thereafter. Once you get past that point, it's just not as much worthwhile. So the real return of a match is only about 2 or 3% when you compound it over 30 or 40 years. Even with the 100% match, it only adds 2 or 3% to your return. So if the Fidelity funds are underperforming the market by about 2% or so per year, guess what the match does? Just make up for the bad performance. You might as well just be investing on your own and not putting your money in that 401k. When I started to wake up to it, you can see why it was pretty hard for me to keep being a financial advisor, because I'd be like, oh, shoot, that doesn't work. Even with the fees, even if you don't factor in the fees, you take the fees out too, and it's even worse, right? Just so you know, your 401k does have fees. It's usually anywhere from about 0.7, 0.65, all the way up to maybe 2% plus. I actually saw a 401k plan that was charging over 2% a year in Washington state. So there's some out there just ridiculous. They have all these fees and they only have to report it on your total returns. You see the return, but you don't see the return. This is why a lot of my clients, they put money away in the year 2000, let it sit there. Most of them never saw it break even until 2015, even though the stock market recovered by 2013. But when you factor out those fees, it took another 2 years of up market to get there. And when you factor in inflation, it took them till past 2020 to finally say, yes, now I finally beat inflation. I'm now past 0% since the year 2000.
To go back to the word fees, I think people focus in on fees because they're generally people who listen to this podcast are a little bit smarter and they focus in on that. But you also got to take into account expenses for a
Mhm.
fund. This is where we deal with this ourselves. Some of the platforms we'll work with and lawyers say the status quo for a lot of these big institutional groups is fee or expenses or like marketing. If the CEO needs to take an airplane trip to do some biz dev with somebody, that comes at top of the line if you think of it.
Yeah. Yeah.
Yeah, so fees are, if you think about it, it's more like bottom of the line. So that's where, like, on the paper statement that comes, you might get 8% was the return. But when you
Yeah.
back out the expenses and then the fees, that might be
You might
low, but
see
it's the
6%.
expenses that kill you too.
That's right. Absolutely. That's the thing that many people just don't realize. If some people are all about the fees and the numbers, they might do their own ETFs, like buy the S&P 500 or whatever. But again, the same problem with the ETF is, like I said, the S&P 500 is already, for those of you who are all about statistics, it's more than 2 standard deviations above where it should be right now. The stock market is more than double where the trend line is of where it should be if it's back in balance. Now, it doesn't mean that it can't stay up there for a little while, but it does mean that, and take this back to dollar cost averaging. Like they always say, don't guess the market, so just keep paying in. The whole premise behind that is buy low, sell high. Guess what we're doing right now? If you keep dollar cost averaging even today, you're still buying high. If you ever notice that a financial advisor never tells you it's a bad time to invest, because if the market's going up, they say keep putting money in because the market's going up. But if it goes down, and I was trained to say this too, right? What would we say if it's going down? It's on sale, right?
Yeah.
It's on sale. You should buy
Always
more.
a
And
good time to be buying, right?
isn't
Okay.
that the best marketing you've ever heard? No wonder they're a multi-billion, if not trillion-dollar businesses, because they brainwash us to believe that these are the rules, that this is the only way to financially succeed. But the truth is not the case. In fact, whenever I pull out the whole dollar cost averaging chart, I would show them the chart of the market going straight up versus one that went down and then back up again. And then one that went down, like the depression, then barely came back up. Like it was like $10 a share, went down to one, and then it came up to four. And I always show them, look, the one that came up to four beat out the other two. The worst one you'd be in is the one that goes up, which is ironic because that's exactly what the stock market does over time, right? Now there's little dips and stuff, but when they say buy the dip, most of them like don't even bother timing it. You're not going to figure it out anyway. So just keep paying money in because you're ignorant, is what they're really saying. But
Yeah.
the best thing to do is go in the stock market when nobody else wants to be in it. Like, how many of us would love to go back to 2009, March of 2009, right before it took off again, and buy in the stock market then? You would have easily more than quadrupled your money in just over 10 short years. But again, they don't tell us to do that. They're like, just keep buying all along the way, all while it's going up and getting more expensive. I actually had one client who did that. In fact, I think he actually found me through your show. Funny enough. I think I was on your show several years ago and he was like listening to different people, even Buck Joffrey, our old friend of ours. And this guy timed it perfectly. The guy in the California military was one of the top generals there. And he actually would bail out of the market just out of pure sheer luck. He bailed out in 1999, right before it tanked. At the
Some
end of
of these stories
2007.
too, and I'm like, man, I don't know if I would have the cojones to get out of that exposure and call it, right?
Yeah,
I would feel worried about missing out on the exposure if it kept running.
exactly. Even he admitted to me, he's honestly, it wasn't because I was smart. I just figured now was the time to pull it out. And I just pulled it out twice and got lucky. Despite all of that, and the fact that he was a high paid military professional, right? Despite all that, he was able to accumulate about $1 million dollars by the time he was 60. Think about that. Most of us are never that lucky. If he bought, and when he did go back in, he went back in after it tanked. So this guy did dollar cost averaging the right way, but not doing it all throughout. He just bailed out right when it was at a high and just happened to jump in when it got low again. Like that's the ideal perfect situation. Even for him to barely hit $1 million tells you something. And again, good saver, like disciplined saver. But that's what bothered me so much. It's if someone wants to live on a 50,000 a year lifestyle, based on if you factor in even conservative rates of inflation, plus the real rates of return of the stock market, you're going to have to save about that much per year to live on that much after inflation. So if you want to live on 50,000 a year, which sucks for most people, you would have to be saving 50,000 a year right now for the next 30 years. If you want to live on 100,000 a year, you got to start saving 100,000 a year for the next 30 years. That's how bad it is when you factor in market returns with the fees, minus the inflation and minus taxes. Taxes got to come out when you put in your money because you can't stuff in Roth IRAs that much. Even the backdoor Roths, we don't know at what point they're going to shut a backdoor Roth anyways. And it's a headache to even try to do it. Trying to do your IRAs or 401ks, you can still got to pay taxes on them in the future. So all the stuff that I realized that I was being taught as a financial advisor, I started to see why even my own father couldn't really retire well. My dad thought he would be dead by 70. We all did. The guy had smoked since the Vietnam War. To this day, he's now 80 years old and is just stretching out every little dollar. He's living on Social Security, doing everything he can to try to make his dollars last because he just didn't know what to do. He worked into his 70s to then live the last 10 years on a tight budget. That is exactly where everybody is going if you keep following the traditional path. You can't do it. And that's what you and I are doing right now, like preaching about alternative investments. And this is what woke me up because when I saw the possibility of what would happen, this is even while I was a financial advisor, when one of my friends said, Chris, look at this. Let's say you have 100 grand. What are you going to live on as a financial advisor? 3%, $3,000 a year. Whoop-de-doo. But Chris, you can go and hard money lend this money to me and I'll pay you 1% a month. I'll pay you 12% a year or 1% a month. How much income is that? I'm like, it's $1,000 a month or 12,000 a year. He's like, exactly. Same money, better cash flow, better return, better income. And that's when I realized that was the solution, right? It's not about how much I accumulate. I'm not a squirrel just trying to hoard up my nuts for the winter of retirement in hopes I can then try not to eat too many nuts in case I have a long winter because I live too long. No, the question is, how do I get my money to start paying me? How can I get my money into real assets? Things are backed up by real assets like real estate, not off the whim of whatever Elon Musk decides to tweet that day or whatever Trump decides to say to the media. I don't want that kind of lack of control. I want control of my money and I want the power. And alternative investment, especially when it's backed by real assets like real estate and things like that, that's when you start to see the real power of everything, right? You start to see, oh, I can take less risk, but still get higher returns, especially when it comes to income. It's always about the income. And that's what ultimately helped me to get myself out of the rat race. But I had to reject everything I was taught as a financial advisor and almost do the opposite. And that's when I started to see real results, which is awesome. Because remember, as a financial advisor is always based on the numbers on a sheet of paper. But when I was getting paid cash flow off my assets, I was like, wait a minute, I'm actually getting paid income. I'm seeing this. It's real. It's not like on a piece of paper or a computer screen that if all of a sudden markets drops, then it's not there anymore. Like this is something that affects my day-to-day living, not just something on a computer.
I think you and I are on the both side of the table with the whole financial planner work. I do think that there's different types of financial planners. If you're working with the big five guys under 5 million in assets, I do think that some of the higher level guys is different, something I'm looking into myself, but maybe just to challenge you, right? I know we beat them up a lot, but what is something that you think that you've learned from your time being a CFP back in the day? I'll say it's something that came up recently. I was interviewing some CFPs earlier today. We were talking about this concept where you take all your assets, even if you are still working, you create some type of net present value calculation. Then you also figure out what is your run rate, your burn rate is what we call it, and then figure out what is that number in the future, and then also backdoor it to a net present value today and see where your balance sheet is at. I don't know what the word for this concept is, but what it basically said, told people, yeah, you got enough money, dude, you're good. And everything else that you have on top of that, go ahead and put it in more riskier, potentially higher performing investments. And I like this model. So we keep the show a little bit more neutral. Like what's something that you did pull out of that world that you hold on today that was suddenly useful?
Really, the only thing would be the perspective of what not to do. I'll be honest, even that what you're describing there is exactly the kind of planning we did. And it's all a bunch of BS. It really is. Because here's the problem. We're just forecasting, right? But we don't know what our expenses are going to look like. Everybody has their own personal inflation rate. My dad, as an example, one thing he did not predict when he worked with financial planners, even after my health insurance kicks in, like how do you put it down in a calculator? How do you account for life changes? What if you account for kids moving back in with you, or maybe aging parents that you got to move in and then you got extra cost there? And so this is the one thing I've learned from financial advising over time is that your life was never meant to be put in a calculator. This is why the longer the plan, the more obsolete the plan is. The only thing you can plan is for the here and now. What can you do this year? That's why I love what we talk about. Like when we help people become financially free here, if you can become free faster, you're not worried about inflation as much. Life events can still happen, curves can still be thrown at you. There's something to be said about diversification. But what I learned about diversification for financial advisors is it's not diversification. Their diversification is all about paper assets, right? There's four asset classes: there's paper, commodities, real estate, and there's business. And I know you do PE stuff, which goes in that business category, right? The problem is everything that financial advisor tends to offer you is all paper assets, annuities, stocks, bonds, mutual funds, even options and things like that are all in one category, which is why people will tend to lose money even if they're diversified in their mutual funds. But if you diversify among different asset classes, like I've got oil and gas in my portfolio, like I've got stuff that pays out based on mineral rights. I've got stuff, a lot of stuff in the real estate space. I've got my own business. That's part of that
Or
business too.
life insurance too is
That
a fifth different asset
I
class,
would still
or
put that paper assets. That's why I say not all paper assets are bad, but I'll put it in that category because it is a paper asset, but it's a good one. It is backed by treasuries and bonds, commodities like gold and silver, besides oil and gas, right? Business is a good one, real estate, of course. But paper assets is not bad. The problem is when clients show me their chart, it's all paper assets when you categorize it, right? Banks, CDs, savings accounts, life insurance, stocks, bonds, mutual funds, they tend to have 100% in that area, other than maybe their own house, which I never really consider an asset because it doesn't pay you anything. So I'm not opposed to stocks. Here's one thing I did learn, not from being a financial advisor, but it was during the same time, was being a stock trader. One of the rules you had as a stock trader is to never trade on a hot tip. So if everybody says something's hot, never buy it. And I've actually used that even when I've bought into the crypto space, which I'm not a big fan of. I still believe that if you're going to gamble in something like crypto or stocks, do it with money that your spouse wouldn't beat you up for. Crypto is one of them. Bitcoin, the end of 2017, right when I was hitting that 20,000 high. And I was telling everybody in December, I was like, guys, this thing's going to come crashing because once people that don't have education start asking you, how do I buy a Bitcoin? Like a high school dropout in my class that was asking, hey, how do you buy a Bitcoin? Do you go to a bank and buy it? And where do the coins? They ship it to you? How do you get it? I'm like, oh crap, dumb money's going in right now. It's about to crash.
you know what
And
the
then it
sell
did.
signal was? It was like maybe November of 2024. Scottie Pippen said we all should go buy Bitcoin.
Once a
So
celebrity gets involved, then you know, right?
yeah.
Exactly. I did that with Bitcoin a couple of times. And I sold it when it got to the high, like March of 22. After I heard a crypto guy talking about how the feds are buying up crypto. They say they're not. I know they are because they got to control the value of the US dollar. So you're going to control anything that might be a threat. And that was when it was about 60,000. And then it came down below 50. And I said, I'm selling. I'm getting out of most of it and let the rest of it ride. Took all my gains out of it and all that kind of stuff. So I did learn that the best time to buy is when nobody wants to buy. This is why I've been looking at multifamily again, because for a while, like 2021, 2022, everybody got multifamily. And I know this because you probably had people approaching you too, but I had so many guys saying, yeah, I'm in the multifamily space. I just started in 2020 or 2021. I'm going to buy this big project. You don't even know what you're doing. You're so green. You're basically a multifamily virgin and you're trying to sell me on why I should buy with you. Like, no way. And what happens, of course, they get their teeth kicked in and they go bankrupt. And it was hard for everybody, even the people experienced like you. I know I've had other guys that I've talked to. They're like, I've been doing this for 30 years. This was the worst 2 years I've ever seen in the multifamily space, even over the Great Recession. That was cake compared to what I experienced in 2022 and 23 and 24. And then you see guys like you that are still standing, like you're still here. And that's so rare to find. But you can tell when those kind of guys just start entering the market and they're all got the dollar signs in their eyes, that's usually when things start to crash. That's when things are too hot. Stock market, same way. When nobody questions the stock market, that's where you go to make money. That's the perfect time to sell away. When you start even, and by the way, Bitcoin, funny enough, my stepfather is like, hey, so how do you do this crypto coin thing? He goes, oh crap, it's happening again. This is back when it's like 110,000 for a Bitcoin. The best time to buy is when nobody wants to buy. And the best time to sell is when everybody's telling you to buy. Like pretty much just do the opposite and you'll probably guess correctly and make a lot more money and be the envy of your friends and they'll think you're a genius. It's Joseph Kennedy, John F. Kennedy's dad. He was a stock trader. The rumor was that he would listen to the shoeshine boy and ask, hey, so what's the hot tip? Like, what's a hot investment to get into right now? And then the shoeshine boy would say, well, here's what I heard from this other guy. It's great. And then he would go back in his office and sell. Like, that's how you know.
Yeah, it makes so much sense, but it is incredibly hard and very rarely do people do that.
That's right. It takes a lot of discipline and a lot of mental fortitude to resist the temptation.
I look at something like in real estate, you look at the cap rates and all different asset classes are different ends of the spectrum and different markets, but just take one data point that's consistent. Class B multifamily in Dallas, so like a 1980s property. I think at the high 2022, 2023, the cap rate was, let's just call it 4. And then it corrected back into the 6s here recently. That's why things are cheaper now, because
Yeah.
it's based off what the cap rate is. In real estate, the old guys will say, you buy when it's a 6 or a 7. You don't buy when it's a 4 or a 5. They know that things trade up and down. You don't know when those peaks and valleys are, but they do trade in the 4 to 6 range. For some reason with stocks, the best thing is earnings per share, but it's detached from that world.
Especially with all the HFT, like the AI type trading, the automated trading that's going on. There's so much speed happening right now. They're all looking for keywords in the media and press. It's like these web crawlers going everywhere trying to find keywords to see if they should buy or sell. It's crazy. That's why we saw, it was 2009. There's one day, I think it was August 2009, one day the Dow Jones dropped 1,000 points in just minutes. It was right when they're starting to play with all this HFT stuff. And they're like, oh crap, we got to put controls on this because we could literally have the market that day to correct it. We have to be so careful because the PE ratios, the price earning ratios, it's so much higher than historically what they said it was supposed to be. And now they're trying to say, maybe there's a new standard. Maybe this is the new normal, as all of us are getting sick of hearing since 2020. All this kind of stuff is, no, I think it's still there. But when everybody becomes very speculative, that's when it's getting out of whack. That's the thing with the stock market. I'm not saying it's going to drop today. And who knows, by the time we record this and it comes out, maybe there's some black swan event that is just a catalyst. But I'll tell you, like, the market's having a really hard time staying up where it is. The only thing driving it is the AI tech boom. If it weren't for that or the Trump effect, you would see the stock market probably drop and correct itself.
Well, you saw Nvidia just drop like 20% because the DeepSeek changed the game a little bit. The way I look at it is there's correction, peaks and troughs. You don't know when it's going to happen, but you look at, like you said, the 4 different asset classes. They all are different cycles. You don't know. Sometimes they both are high and low, but you try and buy the losers. And right now the losers is commercial real estate right now.
Yeah.
Paper assets are high. And who has the cojones to do it, right? Let's just call it what it is.
That's right. That's true.
Yeah.
And that's why 2025, I'm looking a lot more at, especially at multifamily. Like there's things like industrial.
Like office is, the game has changed somewhat there.
Oh
But
yeah.
there's some
Office,
uncertainty.
that's a tough one. Industrial never got hit at all, but it was real estate. It was fine. But like now you're seeing self-storage. Self-storage hasn't quite got to the point where people are asking for reasonable prices yet. So it's still a little bit higher than what the cap rates should let you do, but there's still occasional deals. But I really think multifamily, this will probably be the year you start to see it come back. And I've already seen some people start to find deals again that they couldn't find the last couple of years.
You got to look for the hair, and
Yeah.
self-storage didn't really have the hair. So some people look at it where I want to look for things without hair, but the contrarian investor looks at things completely the opposite.
That's why Warren Buffett says, when everybody's fearful, I get greedy. When everybody's greedy, I get fearful, right? Or everybody's running one direction in the streets, I run the other. I look for blood in the streets or whatever. So that's the thing. It does require you to go against the grain, but when do any of us really want to be with the grain anyways? Because let's look at it. This is why I left financial advising. I was going with the grain, right? I was doing exactly what everybody else is doing by stuffing my money in my 401ks and my IRAs, hoping it was going to work someday. But I realized it wasn't working. I was on the same path as my dad. And just because I was going to be cheap for so many years and sacrifice that time and tell my kids, hey, we'll do Disneyland later because I got a goal to hit, it just wasn't worthwhile. It's what can I do right now? There's just so much more opportunity outside of the traditional mainstream, especially the mutual funds and the 401ks and IRAs. And heck, even if you have IRAs, you can invest in those too, but not have to be in the stock market where it's already way overbought. It's way high priced. So there's a lot of things you can do besides just parking your money wherever your financial advisor makes most money off of. I'll tell you, that's one thing I learned too. As a financial advisor, one of my family members, it came from a wealthy family. He was second generation. His dad was homeless at 16. At 18, he started working for a dealership. At 19, he flew to Atlanta, got the first approved Chrysler dealership in the state of Utah. By age 21, in the 1960s, he was a millionaire. This guy was legit wealthy, even sold off all of his dealerships to the guy that eventually bought the Utah Jazz, the basketball team. I remember sitting down with his son, who's my brother-in-law. I was like, okay, I get with the family. I'm set for life as a financial advisor, right? Because I can manage that family's money and I'd be fine. I sat down with that brother-in-law of mine And I tell you, I prepared for hours to present to him just to make it just right, showing him how to make money, which is laughable now. Also, I got my best suit. I got the best guy from my office to back me up. And I get done with my presentation, and the guy says, "That's nice. So, Chris, you're saying if I put money, say 10 grand with you, you're saying you can make me 12% in a year." I was like, "There's no guarantees. If you look at past performances, the stock market's done 12%, which it really hadn't." So he's okay. That's 1,200 bucks a year. But Chris, I can take that same 10,000 bucks, put a $10,000 down payment on a semi truck, turn around and flip it, and a few months later walk away with a 20 grand profit. So 20 grand in a few months versus maybe 1,200 bucks if I'm lucky with you in a year. Why would I invest my money with you? I was like, you should be diversified. You shouldn't do all that.
But that's my
Ironically, I have
business.
business.
I'm a competent business owner, right? Why would I not bet on myself?
And I believe that overall for people, if you own a business, should be your number one investment, as long as that's not your only investment. Because if you do, see, there was some truth to what I was teaching that you should be diversified. But really what I was saying is, I don't make money unless you invest with me. And the only places I can invest legally is pretty much in things that are like stock based, because that's what my license is, my Series 6 and 63. And I was studying for the 65. And this is where you can invest. Because if you try to do real estate or syndication, I can't be a part of that because, well, I'm a financial advisor and they don't let you even put your own money in those deals. You have to get approval if you have a securities license to even jump in deals like that for your own self, let alone you can't even tell clients to go into. And there are very few financial advisors I do see that are open to those ideas. The problem is, again, they're still being brainwashed by the other side to say, yeah, but put your money over here with us, the institutional money, not there. Do a REIT instead, which I'm like, REITs are a friggin' joke. Somebody asked me, should I invest in a REIT? That's like a copy of a copy. You make so many copies of a copy, it's blurred. You can't hardly see the writing anymore. That's what a REIT is. It's just watered down version of the real thing. And you look at Open Door and all those kind of groups, they were buying for 20% over market value. They didn't care if they made money or not. They're just trying to buy a bunch of assets because people are throwing money at them and they're just trying to find a place to put it. That's why I like, no, REITs are a joke. You can make money in real estate while they lose money. Yes, you could lose money in real estate too, but I'd much rather lose that based on something that I know where I'm invested versus some money manager who's just trying to force a buy,
Yeah.
buying crap so that you feel good because you've invested in quote unquote real estate.
I think I'm like a lot of your clients, right? Business owners who typically have a lot higher net worth. There's that quantum of I'm going to invest in my own business because I get a higher ROI. But for diversification's sake, or people Google the barbell strategy, where you invest in yourself and your business, which is more riskier but higher return.
Yeah.
But you counteract that with the commodities or life insurance, those types of paper assets.
Yeah.
But that's what I personally prescribe to. But
Yeah.
unfortunately, these are the conversations I miss with you, Chris, because we used to be in these masterminds together, but we phased out of these groups. But
Yeah.
for the guys under 2 million net worth who make under $300,000 a year, kind of just sucks in a way, right? And now that if you're like looking at 2% rule, 4% rule, in a way, the only thing that you can do is you're not going to make it.
Yeah.
I think that's the sad part. To your earlier point, right? Like those clients, majority of them didn't have barely anything, $1 million, $2 million.
Yeah.
It's just not enough.
It's possible, but it requires you to act right now. I know you've had a lot of people in the IT space followed me. And there was one guy that I think he found me through you, or I can't remember which one. It took him a year and a half to reach out. I just caught up with him yesterday morning when he started back in 2018. And he had a few rentals. He had 4 rentals, cash flowing about 1,200 a month or something like that. But that was it. Other than that, everything was tied up in 401ks, IRAs. The guy had almost no savings at all. He had equity in the house, but he was the perfect saver. This guy did not have net worth or a lot of money. It was like $500,000 or so of investable assets, if that, and most of it was tied up in the 401k. The good news is that he at least started to take action. He did have a beneficial job change, which opened up his 401k, then self-directed and do some other things with it too. And as I was catching up with him yesterday, just in 7 years, he went from 1,200 a month to now he's over 13,000 a month. And I was like, dude, your extra 50,000 we can actually use over here, get you up over 14,000 a month, which is his goal. His original goal was 6,000 a month. So I like how the goalpost moved, a little bit. He wants to get to 30,000 a month. That gives me hope. That guy, if you take out his house equity, it was less than $1 million for sure. But when you get those assets to produce and you get them in the right places, you preserve it, make sure you try not to lose it at all. And then 2, Make sure that you can actually get in places that do grow and can cash flow too. And that's really what he did. He was disciplined. He got a raise at work and that helped too.
He unlocked that new money, which is a
Yeah,
game changer.
it really
Right?
is.
We got thousands of people on our email list, newsletter, and we see the date that people come in, or at least I do. And but a lot of this is like investor DNA, what we're talking about
Mhm.
earlier. If somebody jumped on my list in 2018 and hasn't even freaking booked a onboarding call with myself, like I just already know they're not the investor DNA that invests off the beaten path, is a consumer investor, the person who there's Sam who goes to invest in the stock market when it's all-time highs, or jumps on the craps table when everybody's winning and throws and the seven comes out, right? They're that investor DNA. And like you said, gotta act now. It's not like you're totally screwed, but you gotta act now. But I can already tell sometimes it's like majority of the times it's just the investor DNA is not there and not gonna make it.
It's so true. People have doubt in two things. They wonder if what you're teaching actually is true and if you're the person to help them there. And then two, are they the right investor to get themselves there? And the one thing I like that you do, Lane, is that you have this podcast, you're teaching it. You probably didn't even know this. I actually been promoting your podcast for several, up until this last year. I was just giving you free advertising space to go to your
'Cause you're
podcast. No, I was just like, hey, fill in a slot. Let's promote Lane's podcast because I know that you teach good stuff here. But like you got that, which is good. That's a good first step is they getting that education. But at some point, the best education is firsthand experience, even if you start small. And that's where, Lane, I know you're good because you've got your own community, your own group, and people that you have, your tribe, your ohana that you have. And it's not just you as a support, but you've got your tribe there too. One of the biggest fears for some people is they're afraid that they're going to screw it up. But the truth is, if you're surrounded by people that are just like you, all trying to do the same thing, that helps build you up too. That kind of keeps you in that safety in numbers. Doesn't mean it's perfect, but it's definitely a lot better when you can bounce ideas off other people. I think that's one of the values that you have with your Ohana. It's like you really give that people that ability to talk with each other and really just get perspective. When you have that, it's much easier to act because you can rely on other people to give you perspective. It doesn't mean they're going to tell you what to do, but it can at least get you over that fear hump that might be dragging you down right now.
And I being probably one of the biggest introverts, Chris knows me a little bit better than most of you. You guys think I'm all extroverted and stuff like that. Boy, you guys wrong on that. But yeah, if little Lane can do that, break out of his shell and meet some cool people like yourself, that's been pivotal to my getting to this point. A lot of people that we work with are very smart, but you run into this case of this the smartest dumb person or the dumbest, very intelligent people, but they take in data, they read books, they listen to podcasts. And I'm like, you got that out of, man, dude, you're uncalibrated. You need to talk to people and align yourself for community is a big thing.
Get
But
your
yeah,
nose out of the book and get into the laboratory. Start testing it, make it work.
close up here, Chris, talking to the person out there who's new to this stuff. We always say just make a leap for it, but easier said than done. Can you remember back to what was that final thing, that tipping point when you were getting off the beaten path of actually deploying money? What was it?
The thing that really helped me was my dad. One of the good things he always taught me was look for real life stuff. You need to get real life experience to really deepen your understanding. What I was looking for, even as a financial advisor, was I wanted to see evidence that it worked in people's lives. The thing that really was the nail in the coffin for me wasn't just that the clients weren't financially free, because you can say maybe they didn't save enough. Notice that financial advisors always put the blame back on you. But the truth was, even the financial advisors were in a place. If they didn't have all their commissions and everything that they earned from their business, they wouldn't be there either. And so that's why I was looking like who actually is financially free? Who does have that kind of lifestyle I was looking for? And it was real estate investors, hands down. Even though a lot of them were flippers, real estate flippers, they're more active investors. The great thing is, from those active investors, I learned you could be a passive investor. Even when I did my own stuff with flipping and a little bit of wholesaling privately with my family and friends, I hated it. Like I have way more fun being the passive investor. That's why, like Lane, I'd much rather have my money with you than trying to throw it out there and just trying to do all the project stuff myself because it's a headache. And that's what worked for me. I was looking for that evidence, like follow the money, and you'll find the freedom is with people just like us doing the same thing. I like when I look for mentors, I look for people that have been there, they've done it, but they're also still doing it today. right? It's not just, hey, I did this back in the 90s, but they can't replicate it in the 2020s. I want to see people that are actually like, they've been able to evolve. And even if they got their teeth kicked in because they had some bad experiences, they learned from it. They were able to shift and maneuver and pivot and say, here's what I learned. Now I'm becoming a wise investor, right? Those are the people I love associating with, So that's my advice. Look for people that have done it, look for the evidence, and then be willing to take action, be willing to put a little bit of faith, even if it's just small. Even means, hey, I'm going to invest 25 grand, 50 grand. By the way, I don't think you should be investing until you got at least 100, 150 grand or more. Otherwise, just keep saving it. That's why I have a lot of people just doing infinite banking now because they're just trying to build up the savings. It's like, don't even worry about passive investments. You got over 200 grand so you can properly diversify. Once you get to that point, try a little bit. You can keep money in the market. Just try a little bit and see what happens. Put it in a couple different places and see if it's for you. You might be like me and get hooked, and all of a sudden, next thing you know, you become financially independent, and then you wonder what you're going to do with the rest of your life. And you wonder if you're going to go to a beach or Hawaii where Lane is, or try to make something more of your life so you can bless more lives.
Yeah. Or you could become one of these guys who are just completely in alternative investments and not even phased by the whole kind of risk profile because that's how they got there. If you guys want to reach out to Chris, Money Ripples podcasts, reach out to him there. I think he and I speak the same language. I think he's a little bit more chill than I am, a little more holistic in approach. I'll end with this story of Chris. We used to be in this mastermind together, and I don't know what they charge these days, maybe like 50 grand a year on these types of things. But we have like presentations we give, and it's serious, right? Some people get competitive with it. For some reason, we got paired up in the same room. And then my other business partner, he's like, "Where's Chris?" I'm like, "I don't know. He hasn't been here in the last couple hours. Where'd he dip out to?" The guy just went for like a freaking massage in the middle of a meeting.
Especially if you run marathons, you got to get those massages.
Yeah, but I was like, you know what? You can be on this journey and do it different ways. So that's Chris for you. And we'll see you guys next time.